If you've ever tried to get a business loan and walked away feeling like the bank didn't want your business, you're not alone. That's actually where SBA loans come in. And for a lot of business owners, they're the best financing tool you've never fully understood. SBA stands for the Small Business Administration. It's a U.S. federal government agency whose entire job is to support small businesses. Now here's the first thing most people get wrong. The SBA doesn't actually lend you money. What the SBA does is guarantee a portion of the loan made by an approved lender, usually a bank or a credit union. That guarantee is the key to everything because it dramatically reduces the lender's risk, which means lenders are willing to offer financing on terms they otherwise wouldn't touch. So when someone says they got an SBA loan, what they really mean is they got a loan from a bank backed by the SBA. That distinction matters. The most well-known program is the SBA 7A loan. This is the flagship. It's the most flexible, the most widely used, and it covers a broad range of purposes: working capital, equipment, real estate, business acquisitions, refinancing existing debt. Loan amounts go up to $5 million, and depending on how the proceeds are used, repayment terms can stretch anywhere from 10 to 25 years. The interest rates are variable, tied to the prime rate plus a spread, and they're regulated by the SBA, so lenders can't just charge whatever they want. The 7A is the one most people mean when they say SBA loan, full stop. Then you have the SBA 504 loan. This one is specifically designed for major fixed assets, commercial real estate, and heavy equipment. It has a unique structure. You're typically looking at three parties. A conventional lender covers about 50%, a certified development company, called a CDC, covers 40% using SBA-backed debentures, and the borrower puts in 10%. The result is long-term fixed-rate financing at below-market rates for assets that would otherwise require much larger down payments. For business owners buying their building, the 504 is often the best structure available. And then there's the SBA microloan program, smaller loans up to $50,000, designed for startups, early-stage businesses, and underserved entrepreneurs who might not qualify for conventional financing at all. These loans come through nonprofit intermediary lenders who also provide business development support. The average microloan is somewhere around $13,000, which doesn't sound like much, but for the right business at the right stage, it can be exactly what's needed. So who qualifies? The SBA has size standards. Your business has to meet the definition of a small business, which varies by industry, but it generally means fewer than 500 employees or annual revenues under a certain threshold. Beyond that, the business must operate for profit, be physically located and operating in the United States, and have reasonable owner equity invested. The SBA also requires that the owner has sought financing elsewhere and can demonstrate they couldn't access it on reasonable terms without the SBA backing. That's what the program was designed for. On the lender side, they'll evaluate your credit score, your time in business, your revenue and cash flow, your debt service coverage, and they'll want collateral wherever possible. SBA loans are not easy money. They require documentation. They take time. But the rates, the amortization, the down payment requirements often make the process worth it. Here's what most people don't understand about the timeline. An SBA 7A loan through a standard lender can take 60 to 90 days or more to close. The SBA does have a preferred lender program, PLP status, where experienced lenders can make credit decisions on behalf of the SBA without waiting for SBA review. Those lenders can close faster. But even still, this is not a quick close product. If you need capital in 2 weeks, SBA is not your answer. If you're planning ahead and want the best terms available for your situation, SBA is absolutely worth the process. A few things worth knowing before you go. SBA loans almost always require a personal guarantee from anyone who owns 20% or more of the business. The SBA is putting the government's credit behind your loan. They want your personal commitment in return. There are also eligible and ineligible use cases. You can't use an SBA loan for passive investment real estate. You can't use it for certain industries the SBA has restricted, and the proceeds have to be used for what you said you'd use them for. Prepayment penalties exist on some SBA loans. particularly 504S. So if you think you might pay off early, understand the structure before you sign. And because the SBA sets maximum interest rates, you can actually compare lenders with a level of transparency that doesn't exist in the conventional market. Use that to your advantage. SBA loans aren't the right fit for every deal or every borrower, but for established small businesses with solid fundamentals that need long-term, affordable capital for equipment, for real estate, for acquisitions, for growth, the SBA programs are among the most powerful financing tools available in the American market. Understand the programs, know what you qualify for, and when the timing is right, use the system the way it was designed to be used. That's SBA Loans Explained. If you found this useful, subscribe. We break down complex capital topics in plain language every week.